Yeah, Jason, you told us before that even if this number were stronger than anticipated, even if unemployment had ticked up, that's not going to be something that would change the Fed's mind because they're going to be looking at inflation, not unemployment. Any hope the market had for them doing an about-face on this, I think, is gone right now.
I certainly think this comes in very close to where you expected, a little bit hotter in terms of the unemployment rate. If you want a glimmer of good news for inflation here, it's that at an annualized rate, average hourly earnings were only up 3.8% this past month. They're volatile from month to month. It's 4.4% rate over the last 3 months. That's still, at a rate like that, you're still talking about an inflation rate that's way above where the Fed wants it to be, but it's come down a little bit. We've been fooled by those data before. We'll get the ECI at the end of the month. That'll be a much more reliable measure of what's going on, but maybe a tiny bit less wage pressure than we might have thought. But everything else in this report, as expected or hotter than expected. The Fed will certainly stay the course after seeing this.
Tyler, when we hear from people who are business leaders and private industry who say the Fed is looking at outdated data, it's looking at numbers that don't keep up with things, is that the case? When you're looking at these numbers, it certainly doesn't show any weakness in the job market or any weakness on issues we might anticipate. Are they getting the whole story or not?
I don't think the Fed is getting terribly outdated data, in part because if you look at the most recent month for CPI and you look at these measures of so-called core or underlying inflation, the trim mean, weighted median, sticky CPI, those are all showing an underlying inflation rate of 7 to 9% at an annualized rate. And when we look at this data for the job market, yes, the unemployment rate declined. It kind of declined for some not so great reasons in that those not in the labor force increased by about 230,000. I think, as Jason said, this is still a sign of a very tight labor market, a lot of labor market pressure, maybe a little bit less than in preceding months, but nothing to materially alter the Fed's path.
Hey, Angela, you've been of the opinion, you've been pretty vocal about it, that this is not the time for the Fed to intentionally slow things down. But this would kind of indicate no matter what they're doing, it's not, at least not yet.
Well, I would argue that the last rate hike they did was just a couple of weeks ago. Certainly, this takes time to show up. And so I don't think we're seeing the full effects of the Fed's actions in these numbers. The other thing I would also say is there's a big downside risk if the Fed is too aggressive. We know that marginalized communities, that Black and brown workers are the first fired, the last hired. And so when we're talking about potentially moving the country into a recession, we are talking about people who are hardest hit by inflation paying the cost of driving inflation down by losing their jobs. And so as I'm seeing these numbers, it's good that we're not seeing a huge drop off right away. But I think we should be very cautious and thoughtful about the effects of the Fed's actions because it will have the most impact on people who are already marginalized in the labor market.
OK, but with unemployment, an official unemployment rate of 3.5%, it seems a little crazy to say that the Fed can't act, particularly when you're looking at inflation levels that have been north of 8%.
I think I would argue that the Fed has acted. It's acted continuously over the last several months. And part of what I think all of the panelists have said is that we are still waiting to see the effects of that. And so I don't think that we can take this job stay alone as a sign that the Fed needs to continue that really aggressive action. I would say this is a good time to step back, wait and see, and make sure that we're not doing long-term damage to the labor market.
Steve, quick point.
The black unemployment rate declined as well, and we're at or near one of the lowest, not the lowest, but one of the lowest differentials between black and white unemployment, which is really interesting, which raises the question. I think the point that was made is right. People of color tend to be, what was said before, which they're the last in, first out. It is very hard. Again, I've been waiting to say this is a recession, and it could have started any month. I don't think it started in the first quarter because those numbers on consumer and business spending were too high. You flatlined a bit in the second quarter, so I could have said the recession started then. I'm just having a hard time saying this recession has begun with numbers like this. And again, getting at things like the black unemployment rate, those are things that start to spike. Not this time. There still seems to be pretty strong demand out there.
Let's continue this conversation in just a minute. But before we do, Saira, I'd just like to get your thoughts on the market's reaction to all of this. We've seen the futures come down but bounce off the lows. Just as a market participant, what do you think? What does this tell us about what the Fed's going to do and what investors should be doing?
I think that what our key concern with this number is supply, which is not coming back. And I don't think we're out of the woods yet. The market's key concern is going to be Q3 earnings, which is coming right up. We're worried about higher input costs, also the strength of the dollar. We're seeing companies already pre-announce financials kick off earnings next week. We think big banks are likely going to struggle. And if you look at consensus earnings, we're still expecting earnings to grow. And we've seen some moderation in that number. But I think earnings going into a recession, it's unlikely to see them continue to grow. So that's going to be the issue. I don't think earnings really reflect the true environment yet. And that's why we think markets could struggle going forward.